This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness. With the people, products, and technology to take you there, it's why they say, at PennyMac, greatness lives here.
Welcome to The Interest. I'm Christine Stewart.
And I'm Mike Savino.
Mike, it looks like you got some sun this weekend.
Yeah, my wife and I went to Cooperstown, New York, and it was such an amazing weekend. We got to tour the Hall of Fame on Saturday, and then on Sunday we went to the Hall of Fame induction for Red Sox legend David Ortiz and the rest of the class that went in.
That's awesome.
Yeah, it was such a great weekend, and it was so great to share it with my dad, and my wife's mom was also a huge baseball fan, but of course, now we're back here at work. It's a busy week with the Fed meeting later this week, and a lot of questions about what the Open Market Committee will do. Will they do another 75 basis point hike like they did in June, or will members be more conservative this time? Inflation keeps going up, and housing prices are likely going to make it hard to get CPI back down. But if the Fed doesn't get this right, experts warn that the housing market could suffer.
The Fed's biggest fear is that those expectations get embedded into wage demands and into consumer behavior.
The Federal Reserve has a huge meeting this week. Experts say the Open Market Committee needs to send the message it has inflation under control before taking its August break. Some of those experts think the Fed will raise the rates 75 basis points, but others think a more conservative 50 basis points hike will show confidence in the economy.
If they have to go higher, there's a strong negative signal that they really are. They're acknowledging that that the inflation is out of control and they don't know what they're doing.
One problem for the Fed, rising housing costs will likely keep putting upward pressure on CPI, which is currently at 9.1% annually.
There's been a lot of talk in the last few weeks about gas prices and oil prices easing and some other prices going down a little bit. But yeah, those rental numbers are going to keep the inflation, going to keep it solid and high.
Chairman Jerome Powell has said that housing prices are a concern for the Fed, but people in the mortgage industry want the Open Market Committee to see that homes are already unaffordable for a lot of people.
I'm hoping, anyway, there's some sensitivity to that, given the fact that, housing and real estate is a little bit of a disaster right now.
The Fed won't directly drive up mortgage rates with its decision Thursday. But if it fails to show it has inflation under control, lenders may have to respond to recession concerns by jacking up mortgage rates yet again.
But for the most part, your agency business and things like that, mortgage rates are really more a function of, whether you want your money in bonds, which is kind of a lower yield, something safe, or you're willing to take a risk on the economy and the stock market.
Still, Joe Cammareri of Mortgage Cadence is confident originators can close deals. He's confident buyers will have the chance to refinance in a few years. He also says new products create loan opportunities for buyers previously shut out of the housing market.
Nothing too crazy, but they're the products starting to fill in for those buyers who had difficulty qualifying for in a way that's traditionally the agencies would drive that.
For the Mortgage News Network, I'm Mike Savino.
One of those new products is the 40-year mortgage. The product is gaining in popularity as more people have less money for a 20% down payment or enough income for a 30-year mortgage. But is it a really a smart move? Let's hear what some experts had to say.
With inflation hitting a 40-year high, the 40-year mortgage may become more widespread as an option for borrowers.
The federal government's move to make 40-year mortgages more available to borrowers is a good thing because people are cash strapped right now.
Bruce Adams, president and CEO of the Credit Union League of Connecticut, warns they're not an option for everyone.
But there's trade-offs to a 40-year mortgage, which is the longer the term of the loan is, the more interest you pay over time, and the slower you build up equity in your house.
So who is the ideal customer for this product, and why are they gaining in popularity?
What we're seeing is people with lower credit scores, less cash on hand, and less cash flow. And they're looking to just get a small piece of the American dream.
So is there actually a market for these types of loans? National Mortgage Professional staff writer Doug Page talked about the pros and cons of this product for the July issue of NMP Magazine.
It's been a viable product, especially for one lender, and that's Needham Bank in Massachusetts. They have about 120 40-year mortgages on the books.
Needham Bank has been selling 40-year mortgages for 4 years, but not every lender participates in this type of lending because they have to keep the mortgages on their books and they can't sell them to Fannie or Freddie. Some non-QM lenders have gotten into the marketplace too.
One is Angel Oak Mortgage Solutions, and the other one is ACC Mortgage. But my impression is that while they have done some business with 40-year mortgages, they have not had the level of success, or they've not sold as many as Needham Bank has.
The product isn't for everyone.
40-year mortgage seems a bit strange, I think, to a lot of people, because you're not going to build up your equity that quickly in a 40-year mortgage.
They have to understand that they're giving up more financing options and a lower return on their investment over time.
But the 40-year mortgage can work for some borrowers, like first-time home buyers, those who want to upgrade to a bigger home, or those looking for a vacation home.
The difference between a 40-year mortgage, at roughly 4.5% versus a 30-year mortgage, which is roughly running at about 5.6%, the monthly payment difference is about $744. So for a lot of people, that's a lot of money.
For the Mortgage News Network, I'm Christine Stewart.
Yield Mortgage is changing how it evaluates creditworthiness as a way to work with new borrowers. The company has launched a new complete rate program that lets potential borrowers use rent payment history and other information to qualify for a loan. Borrowers who have no credit score can still qualify for lower rates under the program if they have a history of consistent rent payments and good residual income. The National Association of Hispanic Real Estate Professionals notes that Hispanic immigrants tend to use credit much less frequently than other populations, which makes it tougher for them to qualify for mortgages. And unfortunately, some very deserving people are either not getting approved to buy a home or paying more for their loans due to their lack of credit history.
This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness.
For more on these and all of today's top stories, go to mortgagenewsnetwork.com.